You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard MacBeth, CEO of the MacBeth Group in Edmonton and author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. Welcome to the show, Hilliard.
Nice to be on.
Talk about bubbles. The Vancouver housing market continues to go up by leaps and bounds for no basic, obvious reason. But now we're hearing about flipping scandals where people are selling their house for, say, $2.5 million, and then the real estate agents, using the assignment clause, flip it a few weeks later for $6 million. That can't give a lot of confidence to people trying to deal in real estate, can it?
No, I think it's. I'm sure it violates some kind of code of the Real Estate Services Act, and I understand that some number of a dozen of people have been chastised for doing that, and they lose their license for 2 or 3 weeks. But with the uproar that's happening after there's been several reports, one from the province, one from the Globe and Mail, and excellent investigative reporting. I'm sure that the government is going to be forced to look into it. I understand that they yesterday appointed a commission, but people aren't necessarily that optimistic because it would take really an outsider to come in and look at it to get the real story. But it's a symptom of a bubble for sure. When people start flipping, that's just a couple of weeks or a month later for a big increase in price. That's the kind of thing that happens towards the end of a bubble. It happened in the dot-com stocks in 1999, 2000. And of course, the problem with that is, and the reason why it's illegal in the stock market is it gives people the wrong impression. And people coming in, say, from China or some other place, look at it, and the realtor shows them a series of transactions where the price has increased every time rapidly. They get the impression that that's real, but it might be somewhat artificial if it's just realtors swapping assignment clauses with other realtors.
How much longer can Vancouver expect to see so much foreign currency come into the real estate market?
Well, one of the most vulnerable markets in the world, other than Hong Kong, would be Vancouver in terms of if there's a hard landing in China. So there's quite a debate about whether China is going to slow down their economy and transition away from construction-based into service-based activity, whether they'll be able to manage it into a soft landing or whether it'll be a hard landing. And one of the issues is if they lose control of the foreign exchange. So that they want the renminbi to decline because the U.S. dollar has been so strong, it's hurting them. But if the people start thinking that their renminbi is going to be devalued, they may use desperate means to get their money out. And this is maybe why so much money has been landing in Vancouver. And so if the Chinese government lose control of that, then all bets are off. A hard landing in China would affect every single one of us all around the world. But Sydney, Australia, and Vancouver, British Columbia have got to be two of the most vulnerable places because an awful lot of money has been going there. Hong Kong, the real estate market's already correcting quite sharply in Hong Kong, so that may be a harbinger of things to come. But certainly I wouldn't bet on the Chinese government being able to manage this without any hiccups. The U.S. went through it in the 1870s and the 1930s where they were transitioning from one kind of economy to another one. Pretty well every economy as it grows has to go through some kind of transition. And the idea that they could do it without any hiccups at all is very optimistic. Realistic, you'd assume that they were going to at least have a few problems along the way. The severe scenario is where they run out of control, they lose control of it, and the one thing the Chinese leadership are terrified of is a situation like the Soviet Union, where one day the Soviet Union was there, the next day it had collapsed, and it was pretty rapid. And there are thousands of mini protests in China every week that you don't hear about, but they are quite worried, I'm sure, about the possibility that transitioning the economy means, in some cases, shutting down steel plants, shutting down aluminum plants, laying people off, and they've never really done that before. And so it's going to be very interesting to watch, and it may affect us in Canada, too.
You said big difference between what's happening with the Canadian banks and the European banks.
Well, the European banks is really interesting. The European banks, of course, have been through this terrible recession/depression for the last 10 years. The Canadian banks have continued they barely felt any impact from the global financial crisis in 2008, 2009. And of course, they've gone on to new highs and new highs. But recently, both the Canadian banks and the European banks have been very weak on the stock market. Today, for instance, the Canadian banks are down between 1.5% and 3%, and the European banks are down by a similar amount, and yet the Dow Jones is up 72 points. So there's something going on. So I thought I'd have a look and see relatively speaking, comparing say an Italian bank to the Royal Bank of Canada, just for fun. And I know that everybody thinks the Royal Bank of Canada is a much superior bank, and in a lot of ways it probably is. But the Italian bank, the largest Italian bank, Intesa Sanpaolo, is trading at less than 1 times book value, and the Royal Bank of Canada is trading at more than 2 times book value. But when you dig into it a little deeper, it's even more interesting because the Italian bank has an enormous amount of loan loss provisions. So to the scale of 25 billion euros. So it's almost like 8% of their total loan book is set aside in case they can't recover some of the loans, if people can't pay back the loans. And that's a very high number. I've never seen a number that high before. Whereas the Canadian banks basically have 0 loan loss provisions. They take a tiny amount each year, as 25 basis points. So a quarter of 1% each year is what they set aside for loan loss provision. But it's about equal to the loan losses. So they aren't building up any accumulation of a safety margin over time, and justifiably they would argue, they say, well, we haven't had any loan losses for so long. Why would we set aside provisions for loan losses? That's a valid argument, except for the fact that when you look at what's happening in Alberta, Saskatchewan, Newfoundland, and potentially in places like Vancouver and Toronto, if the housing bubble bursts, they're going to have a very large increase in loan losses, the Canadian banks are very levered to Canadian real estate, as we've talked about before. So it's an odd situation. So the stocks are trading in Italy at like a half or even less than half of the valuation of the Canadian banks, and they've also got extremely high loan loss reserves, which they probably will never have to use. I mean, that amount of loan loss reserves would be very unlikely they would ever have to use all of those. If they don't use them, by the way, what happens is they're able to, after a certain period of time, the management can decide to say, well, we don't need those loan loss reserves, so they're profit. They're all pure profit. So then they can juice their profits up by the amount of the loan loss reserves that they release back into the profit and loss statement. So, and when we look at the actual economy in Italy, it's actually improving quite dramatically. Earnings are up, growth is up. It's just about the opposite of what you'd judge by looking at the stock market today. So it's an interesting situation. We have dipped our toe in a little bit in Europe and buying some European stocks. So far it hasn't worked out. They've dropped below what prices we got in at, but we are quite optimistic that Europe will find a way out of this. But there are risks. I mean, there's Britain's going to have a referendum on what they call Brexit if they're going to leave the European community. All these refugees from Syria, millions of refugees. There's lots of potential problems, and maybe that's why the European banks are so cheap compared to the Canadian banks.
Now, Alberta just announced its policy on oil royalties and taxes. What's the reaction to it?
Well, the people that supported, and there were a very large number of people that voted for the NDP government in the last election, which was last spring, I guess. They believed the government during the election campaign, when they said they're going to tackle the oil and gas industry and raise the royalty rates, and they're going to do. They had a lot of promises of stuff they were going to do, and then they appointed a panel headed by a guy named Dave Mowat, who's actually from the Vancouver credit union system, and is now head of the Alberta Treasury Branch, which is a government-owned bank. We have an unusual situation in Alberta, and so he got appointed to do this panel review, and according to what you read in the newspaper, because I wasn't involved, they went to the Calgary oil and gas people and said, times are tough right now. I know things are difficult. So how can we help you? Right? So, well, of course, the answer was, well, cut royalties. So so the report came out last week, and people were relieved if they were supporters of the oil and gas industry and owned a lot of shares in oil and gas companies. And on the other hand, some of the NDP supporters were shocked that the NDP government didn't take them on. And they didn't take them on. They basically just confirmed all of the royalty cuts that had happened in the past and even made some further cuts. So one of the issues is, when do you pay royalty? So the idea of the royalty goes back to the king and the serfs and the agricultural land. And basically you had to pay the king first. Like the king didn't care if you made money or lost money, whatever. He wanted his royalty right up front. And then after that, it was your problem if you were the farmer. So now, the way that this one is working, the owner of the resource, which would be the government of Alberta representing the people of Alberta or people of Canada, is saying, okay, you guys take all the revenues, take all your expenses, take a reasonable profit, and then, if any money's left over, pay us a royalty. So that's a little bit backwards, and it's called back-end loaded, but it's it's very generous to, let's put it this way, it's very generous to the oil and gas industry. And unfortunately, that means the revenue from the oil and gas industry is going to be, close to zero probably for the next couple of years if oil prices stay at $28. I'm sure the listeners know that if the WTI price is $28, in Alberta, we're getting something like $13 to $14 because there's quite a big discount for the heavier crude, and we don't have the pipelines to get it out. So the discount reflects the cost of transportation and the lower quality crude that we have here in Alberta. So there's not going to be, if they're starting with $13, $14 or even $15, I'm sure that there's not going to be any money left over to pay the royalty if it's back end loaded like they have decided to do. So the core NDP support, which is obviously a smaller group than all the people that voted for NDP, because there were a number of people that voted for the NDP just to get rid of the progressive conservatives. But that core group, they're horrified. I'm sure that I know a few of them, and they're really disappointed with the government. The government will tell them, we couldn't do anything because of the situation right now in the oil and gas industry, and that's probably valid. But that isn't going to stop them from being really upset. I think their core group is going to be very, very disappointed.
What's the reaction in Alberta to the mayors in the Montreal area opposing an eastern pipeline that would take Alberta crude to New Brunswick to be refined?
Well, I think there's two aspects to that. One is the disappointment about the pipeline, because that pipeline, it may make the best sense of all in terms of keeping it's in a Canadian line, unlike the Keystone, which is taking everything down through the U.S. And it's also fairly easy to do because there's very little new. I'm not an expert on this, but my understanding is most of it follows existing pipelines. So there's a piece of it though that the Montreal mayors, which is the new build part, which they're not willing to support. And I think people in Alberta are just really disappointed in. And of course they link it to the equalization payments, and there's a lot of, there's only a very limited understanding of exactly how equalization works, but they feel that Quebec has been a recipient of equalization and Alberta has been a contributor to equalization, which is correct in the broader sense. And so they don't feel very good about it because they feel like they've been supporting Quebec all this time, and now Quebec turns to support Alberta. When the Quebec's turn comes, the Quebec people won't support them. So, but obviously it's, the other thing is Quebec has a lot of oil and gas. They've got shale oil and shale gas in Quebec. They've never developed it, just like New York and Pennsylvania have. And, New York hasn't developed theirs, but Pennsylvania has. And, so instead of waiting for equalization payments from the government of Canada, Quebec people could have developed their own oil and gas resources, and they would have become a much wealthier part of the world. So this whole pipeline thing and the oil and gas slump that we're in and the recession that inevitably will follow is going to really test the strength of the ties that bind Canada together. And the last thing we need right now, we got a hard landing in China. I'm not saying it is a hard landing, but potentially a hard landing in China. We got oil below $30 a barrel, and on top of that, we get a constitutional separation crisis rearing its ugly head again. That is going to be really tough for the Canadian stock market. Although it would represent an incredible buying opportunity. The strategy would be to take advantage of some of the bargains at that time if all of that comes together. The perfect storm for the Canadian stock market, so to speak. It's hard to imagine Canada going from being regarded as one of the top investment areas, the gold-plated safe haven of the world, to being basically a very troubled place within such a short period of time. But that appears to be what's happening. And if the foreigners pull their money out of Canada, it'll create some really good buying opportunities for people here in Canada, assuming that people in Canada have any money left. So, but one of the things I addressed in my book was the idea that it's important to get some liquidity. Don't have all your money tied up in Canadian real estate, because the buying opportunity of the century is coming. And but if you're all tied up with a bunch of condos that you're renting out, then you won't have any money to take advantage of the buying opportunities. So that I don't know how much impact that's having. It certainly, the message is there, but hopefully people will be prepared, either with some borrowing power that they could use on a line of credit that they use to buy some stuff, or having some money that's not tied up in Canadian assets, and they could bring it back to Canada and buy some bargains. Because once the foreign money leaves, generally it tends to stay away for a number of years. It doesn't come back right away. And so it'll be Canadians who will have to buy the cheap stocks at that point. It won't be foreign people that are buying the cheap stocks.
In Vancouver, of course, the big concern is the rapid, giant rise in real estate prices. But how do you reflect on that, considering you wrote the book When the Bubble Burst, Surviving the Canadian Real Estate Crash?
Well, I think Vancouver's a bubble. I mean, I know that I saw a thing this morning. It's like, one of the big symptoms of the bubble is people tell each other stories that try to justify the prices. And the prices in Vancouver are so stretched. Everybody reads about it every day. You mentioned earlier in this conversation a $2 million house going up to $6 million. And that's an unusual example, but the average home in Vancouver, a single family home, being well above $1.5 million or whatever the number is. The numbers are so amazing I can't even track them anymore. There's just no support for that level of housing with the incomes. Vancouver has incomes that are well below the Canadian average, as I'm sure most people realize. And it's because there's an older population in Vancouver. I mean, a lot of wealthy people in Vancouver own real estate, but they're not necessarily working right now. They're past working age, and younger people find it really hard to buy any real estate in Vancouver because the wages in Vancouver are lower than the wages in Edmonton and Calgary or even Toronto. So that the ratio, which my research showed should never be much above 3.5 to 4, is up in the 10, 11, 12 times ratio, the house to income. So the average household income in Vancouver is $65,000. The average house is, say, $1.2 million. That ratio is just, it's like 12 times or 16 times or something like that. It's just ridiculous. And what happened in the U.S., which is a good guideline, and the U.S. is very similar to Canada, when the ratio got to about 4.5 times, the housing market collapsed and it went all the way down below 3 times. So in Canada, on average, we're at 5 times, but Vancouver is more than 10 times. So now, one of the stories that people pass around about Vancouver to justify why it could possibly be at 10 times forever is comparing it to Manhattan, London, England, and Hong Kong. The problem with that comparison, and it's a major problem, is all 3 of those places, London, Manhattan, and Hong Kong, have a very large number of well-paid financial services people. And these aren't people that are just making $100,000 a year. These are people that are making $1 million, $2 million a year, $5 million a year. And really, very little of that, as far as I know anyway, very little of that exists in Vancouver. And the averages, when you research it, show that the average wages in Vancouver are not high at all, unlike Hong Kong, London, and Manhattan. So to have a really expensive real estate market forever, you need really high incomes, and Vancouver just doesn't have it. So the second thing would be, so that doesn't work. So then the second thing would be a sort of a steady and continual flow of foreign money coming into Vancouver, and there's no history of that ever happening in terms of it can happen for a year or 2 or 5 years or something, but there's no history of it continuing forever. Of course, everybody that's coming in from a foreign land with money to buy real estate can go anywhere in the world. They don't have any problems going to Sydney or San Francisco or Los Angeles or Chicago or wherever. Pick a place. There's too many choices. And Vancouver might be the flavor of the month last year and this year, and next year it'll be some other place. So and especially if the stories in the Globe and Mail are correct about realtors basically fleecing foreign buyers by misrepresenting what actually is happening, by creating these assignments and then trading them at a higher price each time to give the illusion of rising prices. Obviously, the foreign buyers are not knowledgeable about the Vancouver market, but they eventually will figure it out, or somebody will tell them, and then they'll stop coming to Vancouver. You can't abuse people like that forever. If sooner or later they're going to figure it out, and they're not going to be very happy either. So they'll go away.
One sector that's growing in Vancouver, the high-tech industry, one of the CEOs just complained. He said, I fly people in from across the country to take a look at the job, which they love. They take a look at the city. It's a beautiful place. And then they look at the real estate prices, and they jump back home on the next plane. Yeah.
No, I think that's exactly right. I talked to people in our company and other people in the financial services industry, and because even Toronto is relatively expensive for office space and that sort of thing, and suggested to them that what about moving the head office to Calgary? I didn't say Edmonton because that would be too big a stretch, but Calgary, beautiful mountains, contemporary city, and that sort of thing. And when you compare the cost of housing in Calgary to Vancouver, or even Toronto, and also the cost of office space, it's just, there's no comparison. I mean, there's such a big surplus of office space in Calgary now that undoubtedly a major high-tech company in Vancouver could get rent at basically $0 per square foot. All they would have to pay would be the operating costs, which, heating, lighting, air conditioning, and that would be an enormous savings. Plus, there's a huge pool of underemployed young people in Calgary, well-educated and very young. There's a really marked age difference between between Calgary and other cities in terms of the age of the people. So, and of course, with all the layoffs in the oil and gas industry. Now, the only problem is retraining a petroleum engineer to become an electrical software engineer is going to be a challenge. But those kind of challenges, if you got really bright people, they can be overcome. I'm sure. And so I think Calgary's got a much better chance of attracting those people to move from Toronto than Vancouver would ever have. People are coming from Toronto to look at Vancouver, and they find it too expensive. That's a pretty amazing thing. So that's what happens. I mean, that's why it can't go on forever. That's exactly the reasoning. And you can't have a city just based on a bunch of people who have been here for 40 years and are sitting on a capital gain of $2 million on their house but don't have any income. That's not a economy that's going to last longer term. It just doesn't. I can't think of any place in the world where that's a viable economy. So something has to be done about getting the cost down. And I understand that the politicians in Vancouver, the mayor and the premier of British Columbia, are feeling the heat right now because of these investigative reports that have come out. But it's also not exactly clear what they can do to fix the problem. It's going to be a long-term fix, I'm sure.
Well, markets tend to fix themselves whether politicians like it or not.
Yeah, that's true. And that's with bubbles, that's exactly what happens. People have tried to, artificially burst the bubble before it gets to, and there's, lots of examples of bubbles over the last 400 years. And usually what happens is, in fact, maybe in every case, what happens is they follow their own course and eventually they burst themselves just out of their own lack of momentum. Because when you think about it, that real estate being at, the average price being at $2 million or whatever it is in Vancouver, you need a larger and larger amount of new money coming in order to justify those prices or to support those prices. So when the average price was $500,000, say 10 years ago, it took a small amount of money to get that house to go from $500,000 to $600,000 to $700,000. But to get that house at $2 million to go to $3 million, it takes a lot more money. And very, very few people can buy a $2 million house. It's just like there's almost nobody that has an income high enough to afford a mortgage to buy a $2 million house. So then you're relying on the people who have the cash. Well, that's a tiny percentage of the population. I've been doing this advisory financial services job for almost 40 years, and lots of high net worth clients. I mean, over the years, many, many, many high net worth clients. And I could tell you the people that can actually sit down and write a check for cash for a $2 million house, there's very few of them. And I've been in a province, Alberta, where the incomes are much higher than average. So it's just it's a bizarre thing. It's a very bizarre bubble, and it's going to be very entertaining unless you're somebody with a large mortgage sitting in Vancouver that's worrying about it going down. But for everybody else, it's going to be very very entertaining. But I don't know if it'll be like there's something that's happening in Canada with Alberta and the oil and gas industry. There's a certain amount of that, what they call that Schadenfreude, where people are kind of enjoying the misery that's, and Albertans probably deserve a little bit of that because they've been arrogant about their success for so many years. So it's natural that people say from other parts of Canada would say, oh, look at those guys, they're suffering right now. And I saw a cartoon about the oil and gas worker needs help because he forgot to save any money. And so I don't know if people are going to feel the same way about Vancouver real estate. If people generally don't shed too many tears for people who bought a house at $300,000 and then sold it at $2 million. I can't imagine them getting too much sympathy.
Hilliard, thanks a lot for chatting with us.
Great to talk.
My guest has been Hilliard MacBeth, CEO of the MacBethGroup.com in Edmonton and author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. You can forward comments to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.